Hey guys, my name is Kieran Trade, and this is going to be the first video of many, and this one is going to be about liquidity. I'm going to be doing a series where I'm teaching ICT concepts and the exact model I use and all the components that go with it. So I hope you enjoy the video and I hope you get something out of this. If you do like my content, please check my others. I do post some valuable stuff, and yeah, please enjoy the video. So liquidity is the main reason why the markets move, and you need to nail this in order to become a profitable trader, in my opinion. And in this video, I'm going to go all over that, so do not worry. My name is Kieran Trade. I hope you are enjoying the content. So I tend to use 5 types of liquidity, and these are equal highs and lows. We've got data wicks, LRLR, which is trendline liquidity, and session highs and lows, and previous day high low. Now let's go into the chart, and I'm going to show you an example of these. So with equal highs, you can see on here we have, this is a 1 minute chart. We have these two equal highs. They have to be the exact same. So you see the high on this candle was 142.75 and this one was 142.75 as well. So this is a very good target. So as you can see, we did actually inverse the fair value gap here, which we'll get into in a later video, and targeted this straight after. This is a very good liquidity point, probably one of my favorites, but there are certain conditions that will make it even better. So on the 1 minute chart, this is good, but it's not the highest probability. If we were to go to the 5 minute chart and we see the exact same thing, so you see we have one here and then here, right, whatever. These are two highs, okay? So these two highs, you draw them out, you can see they're exactly the same level, okay? So on the 5 minute, this is a very good draw on liquidity. But on the 1 minute, it's good, but it's not as high probability as the 5. Now, on to the next one. So if we go down, we have data wicks. Now, data wicks are news release wicks. They have to be very wicky. So you can see here, we've got this nice wick. For example, if this was a data wick, which it isn't, it would be a very good one because you see it's quite large. The body is small and the wick is large. Now, if we had a data wick that looked like this, let's say this candle here, like the body on this is not very good. You can see it's just mainly body, not very wicky at all. I think there's probably a better example like this. So like if this was a, let's say, data candle, this wouldn't be very good because obviously it's got a thick body, the wicks are short. It's not a very big candle either. Now, on to the next one, we have LRLR, which is low resistance liquidity run. Now, this is also basically trendline liquidity. I don't know why people call it LRLR, because in my opinion, it's just trendline liquidity. But anyway, if we come over here, I've marked it out here for you. So we've got the first tap, second tap, third tap / fourth tap, and then you see we break here and we target this high. So you don't really know if you're going to run the full thing or you're just going to run the first high that was the last tap. So I tend to just adjust my risk and my partials to that. Now, if you were, let's say you were bullish on the day, then you would target this. This is a perfect target. So you would look for bullish setups and target any of these sort of highs. Also on higher time frames, these are obviously a lot stronger liquidity runs, but they still work very well on the 1 minute to 5 minute. Next, we have session highs and lows. So this would just be London session / Asian session, either or. So you can see here on this day, we had the London high was here and the Asian high was here. We take this, so we could have been looking to get bullish anytime before here. Obviously, this was pre-market, so you wouldn't be trading before then. But yeah, so they're very good. London, there we go. What the hell? There we go. So they're very good liquidity draws, and they will be targeted a lot of the time. And then onto the next one, we have previous day highs and lows. Now, previous day highs and lows, you can see we go to the high time frame, let's say 15 minute, and you scroll out. What you can do is, if we were, let's say, trading on Friday, you go back to Thursday price price action, and you would just find the highest point and the lowest point. So I believe the lowest point was here. So you can see on Friday, we took out the previous day low, and then you could either target another liquidity draw or target target the previous day high. And that majority of the time is a very good confluence to use. Yeah, you can see after we take the high as well, there's a nice reaction. So you can benefit from this reaction from taking these orders, or even down here, you can see we have a very good one. Obviously, this happened in the London session. So you probably would not be trading that, but it's still a very good confluence if you did take it in the New York session. Okay, now on to previous day high and low. So, okay. So now we're going to move on to something that not a lot of people talk about, and that is, if I can find it, internal versus external liquidity. So for example, you can see if we are in an uptrend, the market usually goes from internal to external. Sometimes it will flip, and that's when you have the break of the chain, but majority of the time it's going from internal to external, external to internal. So fair value gaps as well are also classed as internal, in my opinion. In this example, what we would expect is for price to, let's say this is the 1 hour time frame. We're then looking to go, after we've taken the external draw, we're now looking to take the internal draw in one of these. So this is obviously your external as well, in this range. So in this price action up here, you probably see something like this. And then the internal could be this low. So you would think the price is going to come here, maybe it hits a fair value gap, and then we move back up to take the external. So that is a very good way to base your bias and targets for the day. You can get some really nice big wins from using it internal and external. I found that it helps a lot when targeting higher RRs. So overall, it's a very good thing to know. If we go onto the main chart, you have a look at this yourselves. So what do we do? Let's go to the 15-minute time frame. In this example, let's remove these. So in this example, you see we come up here. So this is probably a 1 hour leg. This would be our 1 hour leg up. You see we took the external, and now we're going to internal. So you could expect a push from here, although we haven't come down to hit the 50%. So you might expect this to be your turning point, or this could be your turning point. So after the market's taken external, you then look to go to internal, which we've hit here, here. Internal lows and highs as well obviously can be used as internal and external liquidity. Internal liquidity. So yeah, but if we go to the 1 hour, price could come down. I think we did actually tap into this fair value gap here, and that would be your internal as well as your individual price swings. So why does the market even target liquidity? Like, why does it move a certain way before and after hitting those levels? So when you look at the market, you will have buy and sell orders constantly. Now, if I go to the highlighter and let's change this to blue. So blue is buy orders, okay? So here you'll see we come down, we've got a lot of buy orders resting here, and where people have bought and the price has gone up, and then more buy orders resting here and price has gone up, and there's just a constant flow of market orders. So for example, there will also be sell orders up here, there'll also be sell orders here, there'll be a lot of sell orders here, and so on. Now, the price will target these areas to take people's stops. So under here, what's resting under here is buy orders. Now, not only buy orders, but sell orders. So the reason why price will come down and take these levels is because the people that also have their sells here and their sell stops here and their buys here, meaning that the buys get stopped out and the sells also get put into their trades and then they get stopped out as well. The reason why this works is because big institutions, if they want to place large orders, they have to have an opposing buyer for their sell or a seller for their buy. So let's say there was 100 marbles and there are 3 people participating in the purchase of these 100 marbles. Now, there's one guy, let's say John, let's just mark him as J. He has 10 marbles, and let's say Sarah has 30 marbles. So in total,
they have 40 marbles. Now I want to buy all 100 marbles. So how am I going to buy all 100 marbles if these two still hold their amount? So I need to buy back theirs. So if I was to buy back theirs, and what the market does is obviously we would just simply say, okay, I want to buy yours, there you go, you buy it. But the market can't do that, and institutions can't do that. So the way they do that is they force people to sell by liquidity runs. So then what they would do, let's say this was your there you go. So we have a lot of liquidity resting here. Now, if an institution wants to buy, let's say they're 100 marbles, and there was 40 marbles lying under here, that means they would have to take those marbles out and force these people to sell them before they can then buy the marbles back to get the 100. I hope that makes sense, and I hope that opened your eyes a bit onto liquidity. Please, if this helps, please drop a subscribe. It would mean a lot, and I hope you enjoyed.